Thank you, Ailco, and thank you to your panelists, Stephanie and Alex. Our next segment is titled What's Needed for Emerging and Frontier Markets to Thrive in a Post-Pandemic World, with a focus on Africa and Pakistan. Our speaker is Charlie Robertson, Global Chief Economist, Renaissance Capital. Charlie is an emerging market specialist covering global economic themes and is the lead author of the book, The Fastest Billion, the story behind Africa's economic revolution. Charlie will discuss his economic outlook and a range of topics related to the drivers of growth in the Africa region and frontier markets such as Pakistan. And I'll join Charlie at the end of his presentation with a few follow-up questions. So Charlie, hello, welcome. I hand it over to you.
Thank you so much for having me on. This is a privilege to be talking to you. I'm always impressed by anyone whose CV has a CFA on it. So I just appreciate being invited. Thank you very much. I've been asked to focus on kind of frontier and emerging markets, and I'm going to be a bit broader than I perhaps suggested a month or two ago when we first got in contact. But I'm going to take you on a journey which looks back over the last 50, 60 years or more, and hopefully takes you forward 10 years too. To put it into topical news right now, how have the lowest income countries been hit in the world? And the first graph is just looking at GDP kind of growth rates for, let's use sub-Sahara as a base for low-income countries. And they outperformed in the global financial crisis, much better growth than everybody else. And they outperformed again in 2020. Now, 2008 is because the financial sector wasn't very big. 2020 is because the retail sector wasn't very big. And they've been recovering pretty well. In terms of COVID and the actual hit, it's been very, very mild, at least in health terms, at least in terms of the official data. Roughly 0% of people who've died in Nigeria in the last 2 years have died of COVID. In India, which has been hit harder, it's a few percent. And in a developed market like the UK, it's about 12%. So COVID has not been a massive hit either on the GDP side nor on the health side. And obviously that's related to the age factor, which we saw as soon as the Chinese released those figures back in, I think it was February, March 2020. And we recognized that youth was going to be of an advantage. And a country like Nigeria, where the median age is 16, unsurprisingly, there are very few officially recorded deaths from COVID relative to normal annual death loads. But this graph is vastly more important for telling us how an economy is doing and how an economy is structured. And I do want you to think about it, because I'm going to come back to it, or at least I'm going to ask you to keep it in mind when you think about Japan, with its average age nearly 50 years old. Average age. It's just an incredible number of elderly there. The US, middle-aged, about 37 median age, and so on. And then the successful emerging markets, the ones that are booming right now, places like India at about 27. Because when we look back over like 50, 60 years, this is the most complicated chart I'm going to show you. I don't even really expect you to be able to read all the numbers. But along the bottom, we're trying to show what GDP per capita was for some countries versus America. America is the constant in this. In 1960 along the bottom, and in 2017 along the left-hand side. The winning countries, the ones like Korea, went from 7% of US per capita GDP in 1960 to 64% of America's per capita GDP by 2017. Top left-hand corner, along with Taiwan, Romania, Thailand, all these successful economies. There are a whole heap of other countries, and these are the ones that I'm particularly interested in, which have actually gone backwards relative to the States. Or that's not quite fair. There's been progress, but America's progressed much further. Why? The first most important story explaining this is really simple. It's basic education. It's just adult literacy. And if you want to know why, say, India is 25 years behind China, why you've got more manufactured goods in your house made in China than India, it's because India's adult literacy only crossed 70%, which is a key threshold, in the last 10 years. China did it in the 1990s. Developed markets did it in the 19th century, which is why the Industrial Revolution began there, and has then spread through Japan, Asia, and so on. And if we look at most emerging markets, you can see that all of them have been literate for decades now, and that's why it's a huge asset class. It's why you probably invest in there one way or another. There are a couple of exceptions. Pakistan, I've still got on this table. It's just been downgraded to frontier status by MSCI recently. So that gives you the kind of big picture. You've got to be 70% adult literacy to be able to industrialize. Sub 40%, which is in red, the big kind of red block areas here, you can't even grow sustainably. And that was the disastrous legacy of colonialism. Or certainly colonialism did nothing much to resolve the problem. And countries became independent across Africa anyway in 1960 without the means to grow sustainably. They could grow because oil prices boomed if they exported oil, or if there was a gold mine that suddenly started producing gold, but it wasn't going to be a sustainable story. The really encouraging reason that I pay so much attention to Africa in particular is that the green is now coming through quite strongly. A host of countries are looking good on this. Now, what's really, really amazing is how long the lag effect of this is. I looked at the Russian Revolution once in 1917, and the adult education data from 20 years before that, the 1890s, is a fantastic guide to wealth levels today in the former Soviet Union. And indeed, the figures I've just shown you on Africa tell us where per capita GDP is in 2020. When I've asked kids at a sixth form, kind of 16, 17-year-old kids at schools, just using education data from 1950 to tell me who's the wealthiest in 2020, they correctly tell me it's Mauritius from the table I give them. The only country to have had better education than Mauritius in 1950 was Seychelles. And Seychelles is the richest country in Africa, and Mauritius is the second richest country in Africa. So this is absolutely essential stuff. So when I normally show a picture of Africa, I focus on GDP figures, and this is my attempt to be artistic on Excel. It's not brilliant, but each box there is $1 or $2 billion. It's $2 billion, and it's giving you a sense of which of the biggest GDPs, biggest economies in Africa. But I'm more interested in the population figures, and each box here is 1 million people. And the dark green is where adult literacy is over 80%. The light green is where it's over 70%, so you can industrialize. And you look at that picture, and you can see that most people on the continent can now do it. They can get that growth rates in the future that we've already seen that Korea got in the past. Top right-hand corner, you might not be able to see it very well, but it's showing you Bangladesh and Vietnam and Sri Lanka, all countries that also have that high adult literacy. So it's one of the reasons Vietnam's so popular among global investors. Trouble is, it's all very well having your educated people, and they don't have to be very well educated to work in a textile mill, but they do need to be able to read and write. That textile mill will not work without electricity. I was reading up Adam Smith's Wealth of Nations to try and see whether he was talking much about this 250 years ago. He didn't focus much on literacy. And I think it's because in Scotland it was 100%, even in 1750 or close enough. He did focus on power. He said all the factories are moving to where there's power, which in those days was coal. Today it's electricity. Green is good, grey is not good, And grey is where there's just not enough electricity to power factories. And this is why you don't buy. The clothes you've got in your cupboard are made in Bangladesh, which has got plenty of electricity, top right-hand corner, it's in green, and not from Ethiopia, despite the media reports you may have read, which just doesn't have enough electricity to power its mills, to power mills of any size. So electricity is really key. How do you pay for an electricity grid? It's billions and billions of dollars. Where does that money come from? Well, if you're lucky, like Botswana, you export $2,000–3,000 worth of goods per person every year, and those exports give you the cash you need. Now, it works for Botswana because it exports a lot of diamonds, but it's got no people. Doesn't work. It's got no people. It's got less than 2 million people. It doesn't work if you're a Nigeria or a Zambia or a Democratic Republic of Congo. Congo's got all the cobalt and copper we need for electricity, Green Star batteries, and all of that, but it's got so many people, 100 million or so, that it makes nothing from the exports per person. You'd have to see oil prices at $400 a barrel for Nigeria to be as well off as Botswana. Another way of showing it is looking at these oil exports per 1,000 people every day. Countries on the left, Qatar, Kuwait, looking amazing, huge amounts of money every day, just wealth pouring out of the soil, and Nigeria on the far right-hand side, just 7 barrels per 1,000 people. And half of the money for those barrels goes to the oil majors who are getting it out of the ground. So there's very, very little left over, a couple of dollars a week per person, maybe. So commodities aren't doing it for most countries. So where does the money come from to roll out your electricity grid? Because you've got to have the power to be able to industrialize. But you could go to the banks, but you can't in certain countries like Nigeria, Tanzania, Zambia, Uganda. The banks that have got loads of cash, Mauritius, Morocco, Tunisia, are, they're great. Why have they got loads of money? Why have they got lending of over 100% of GDP in some cases, while in Nigeria it's closer to 20? Well, it's partly because there's no deposits of any size in Nigeria either. And the really, really interesting link, to come back to that age thing I was showing you a few slides back, is it's related to age and fertility. So the more kids you have, on average, in a country per woman, the smaller your banking system is. In Angola and Nigeria, it's a very complicated graph. The key point is in the top right-hand corner, and you'll see these blue columns. 5 to 6 kids is consistent. 5 to 6 kids per woman is consistent with about 20% of GDP on deposit in the banking system. That means you're only lending 20% of GDP, which means you don't have much of an electricity grid. What you really want to see this big boom in deposits is fertility rate of 2 to 3 kids per woman. And what's wonderful about what happens then is not only do the deposits rise, but the interest rates collapse. So when you've got a small banking system like Angola, we just talked about, or Egypt, or Kenya, or Nigeria, your interest rates are double digit, 10, 15, 20%. When you've got low fertility, few kids per woman, your interest rates are 0, 1, 2, 3%. People think, and keep on telling me, that African risk is mispriced by the markets. But I think African risk pricing is priced off dollar bonds, and those dollar bonds reflect local interest rates as well. A country like Morocco has got extremely low local and foreign borrowing costs. For too much of sub-Sahara, it's both high local and high foreign borrowing costs. So the big driver for when countries start to take off is when those fertility rates come down. And when it happens, you get what everyone talks about as the demographic dividend. So too many people still talk about youthful populations as being a positive. Actually, the positive is when they stop being as youthful, which is why India, with a median age of 27, is doing better than Nigeria with a median age of 16. So this is a map of Africa I'm showing you now, and it's where is the success stories likely to be there in the green countries. Morocco is leading Africa's second industrialization wave. We have had one already in Mauritius and Zimbabwe and South Africa. This is the second, which is being led by Morocco. And as countries like Egypt and Ethiopia and Kenya and Ghana, which are that very light beigey color in this, as they get their fertility rates below 3, which is going to happen in the next 5 to 10 years, they're going to follow. Pakistan's going to do it too. They're going to follow that Asian success story we've seen already. Big rise in banking systems, big fall in interest rates, big rise of investment, industrialization. When's it going to happen? So this is a quick slide showing you fertility rates and when they're projected to fall by the United Nations. And the problem is right now is that, well, for some countries, Angola say, is they're not going to get below 3 kids per woman before 2050, which means they stay in poverty for the next 30 years, unless the government does something. And what can you do? Well, you don't have to go the whole hog of the Chinese kind of, and I wouldn't recommend any country to do that. In fact, China's running into the problem now of too few kids. And I wonder if the one-child policy was part of why they've got into that mess. You don't want to be doing that. You just do educating girls. The longer they stay in school, the later they have their first kid. The longer they stay in school, the more opportunities to work, which also encourages a different view on perfect family size. But perhaps even more simple, or relatively simple, reduce infant mortality rates. It's the most shocking number when I was thinking about COVID for the last 2 years has been that as of a month or two ago, I think it was 2% of people had died of COVID who'd officially got it. And there's something like 2%. I mean, the actual numbers, we know the death rate's lower than that, but it was something like 2%. The death rate of being an African child is 7%. You're 3.5 times more likely to die if you're under 5 as an African child than if you get COVID at any point in the last 2 years. So reducing that infant mortality rate, what it has got is a very strong relationship to fertility rates. When kids survive, parents have less of them. And although that sounds like it's an expensive thing to be able to do, how do you get infant mortality rates down? What I'm showing on this graph is that in Nigeria, they have over 10% of kids under 5 die, versus something like 3% in Venezuela. Same wealth level, hugely different infant mortality rates. So a government that's focused on this can get the fertility rate down. That then sends savings up. That then produces this strong growth and makes countries much, much better off. So the success story you're already well aware of is exemplified on this chart of Asia versus Africa. Africa, the share of the population that's under 18 in blue has not really changed in 70 years. While in Asia, it's dropped from 45% to now under 30%. Asia's flush with cash and savings, so much so that Chinese savings have been lent to Africa, in fact. Africa's still short of savings. So when you get this all coming good, then you get this fantastic per capita GDP growth. Once the fertility rate is coming down, you get this very strong per capita GDP growth of in China's case, 7% a year for the last 30 years. Korea, 5 to 6% a year for the last 30 years. Brilliant, brilliant stories. And that's what creates that convergence we talked about right at the beginning in that complicated table about Korea versus America. There's one other part of the story which was a bit of a surprise when we looked into it, but is really obvious once you think about it. And it's looking at how much growth is determined by the share of kids in the population. And I go to Nigeria a lot, so I'm going to use that as my reference point. You've got roughly let's say 200 million people in the country, roughly 100 million are kids, roughly 50 million adults staying at home to look after the kids, giving you what, 50 million adults to go out and work in a population of 200 million. It's only a quarter of the people. If the number of kids was, say, 60 million, you need 30 million adults staying at home to look after them. That's giving you 110 million adults out at work instead of 50. Same population size, completely different ratio, completely different numbers of people who can go out and work. So when the ratio of adults is sitting at 1, which is what this chart's trying to show you, is sitting at 1 adult per kid, your per capita GDP growth is 1.4%. It's not great. America does that. Does better than that. You don't converge with America. But when you start to have 2 kids, 2.5 kids per woman, adults, sorry, per child now, a different ratio. When you start to get 2 kids, then you grow at what? 3, 4, 5% per capita. Then you're Korea, then you're China, then you're booming. And emerging markets and frontier, I'm really not expecting you to be able to read the numbers on this graph. That's not really the point. The point of this slide is to show you on the bottom side, when countries turn green, i.e. when their per capita GDP starts jumping. And for emerging markets, it started at about 1990, 1995. Until 1980, no one invested in emerging markets. Countries like Brazil were the country of tomorrow, as Charles de Gaulle apparently called it, and it always will be, is what is the end of his quote. Country of the future, which always will be. But from the 2000s, 2010s, in fact, all the way through to 2040 at least, emerging markets are where it's at. Fantastic ratio of adults to kids, maximum numbers of people out there working, and because they've had few kids, with very high savings and quite low interest rates. It's a wonderful combination. Korea is going to be the first interesting one, and Greece. Korea and Greece are the ones to watch in terms of what happens when we start getting too old, because they are getting there fast. And that will be something that I'll be intrigued to see in the 2030s. Just how bad does their growth get? But we're not there yet. We're not there yet. Now, for frontier, actually, for a lot of the frontier countries, as defined by MSCI, it's really quite a good story. Quite a lot of the Baltic states look good. Some of the Europeans are looking good. Kazakhstan's looking good. Actually, very interesting as well. It's countries like Nigeria still, Senegal, which still don't have a good ratio. Just too many adults not able to work. Too many kids as a share of the population. Anyway, so this is the big picture, which is telling you who's going to be successful and when. It's why everyone loves Vietnam. It comes out brilliantly in all of these tables. What do you do today if you're a government that hasn't got commodity revenues of any size, like Nigeria, that's got a high fertility rate, and you're not going to change it tomorrow? What do? Do you just sit there and wait 20 years until your demographics get better? Or do you say, we've got a great opportunity to go out and borrow money at low interest rates, to do relatively low interest rates, to try and kickstart industrialization? And I think it's being helped. In the last 10 years, we've seen some of this, and it's been helped by this fall in global interest rates. Now, this chart is showing you Japan since 1990, and Germany in red is following it. But Germany in red since 2007. It's almost exactly following it. And then America's a little bit above. This is long-term interest rates, 10-year interest rates, a little bit above Germany. What I assume is going to happen is that German rates are going to stay at 0, because they're an old country. They save money. They're not going out and spending in a big way anymore, just like the Japanese haven't been for a very long time. America's a younger country, spends more inflation, higher interest rates. So the base case is German rates stay at 0. US rates, 10-year, stays at about 2. And historically, that is really cheap. So that has had this very positive knock-on effect for other countries, lower income countries. Places like South Africa and Egypt and Nigeria, just in the last 6 or 7 years have gone out and borrowed a lot in the Eurobond markets. Because if US rates are down at roughly 2, then Nigerian borrowing costs, yes, they're considerably higher, but actually not as frighteningly high as they were 10 or 20 years ago. So this is an attempt by governments to borrow, to try and kickstart that industrialization, to find the money to pay for electricity, to pay for ports, to pay for roads, the stuff you need to get goods made and out of the country. Trouble is that it hasn't produced the export growth, or at least in some of the countries, it hasn't produced the export growth it needs to do. If you're going to go and borrow foreign money, you also need to then make sure you're building up some export revenues to earn foreign money to pay back that foreign debt. Now, I'm not showing you a graph of Asia, but if I did, Vietnam would come out really well. They've borrowed a lot of money in dollars over the last 10 years, but their ratio of external debt, foreign debt to exports has fallen, even as their foreign debt's gone up in dollars. And the reason it's fallen is because their exports have just taken off. Samsung and Intel and Honda and all the rest are doing extremely well there. When I do this graph for Africa, unfortunately, that's not the case. From 2010 to now, the ratio of external debt to exports, instead of falling like Vietnam, has gone up from 300% to over 1,000% in Ethiopia's case. And they went to the G20 a few months back, well, okay, a year ago now, to say we need to restructure our debt. We've got Seychelles on there, Mauritius. I'm being a bit unfair on this chart. I'm just looking at goods, exports of goods, not exports of services. And if you're Seychelles, all you do is export services, really, tourism, then I'm being a little unfair. But you've had other countries as well, like Zambia, also be going to ask for debt forgiveness, and Chad. And I think we are going to see quite a few more, unless we get a really remarkable export boom. And there's not an awful lot of evidence of that right now. And government debt levels have also built up. Because the difficulty here is that the governments, it's all very well me talking about 10, 20, 30-year demographic trends. Governments have got 4 or 5-year election trends in most places. They haven't got time to wait. So they borrow from abroad and they borrow internally as well. And we've seen the ratio of government debt to revenues, the ability to pay that debt, deteriorate significantly over the last 10 years or so. So this is looking at 2010 and 2021 data. And again, the countries that have defaulted, Ethiopia, Zambia, are second and third in this list. Ghana's up there as vulnerable, and Nigeria's potentially vulnerable too. And it's particularly problematic given the high interest rates that are inevitable when you have a small banking system. So countries with very high interest burden, places like Egypt, Ghana, Sri Lanka, Pakistan, they've got to either be incredibly good on the reform side, raising revenues, or go to the IMF and say, please give us the support you can, or they run the risk of default. And Sri Lanka is certainly priced to default right now. Ghana is heading that way. Egypt, very good reform story since 2014, and good IMF support for many years as well. Pakistan, shaky relations with the IMF. And I guess what I'm trying to flag here is that the risks are growing, and we have seen that reflected in Eurobond prices. I'm just showing you Egypt, Ghana, and Nigeria on this particular graph, and you don't have to see all the lines. The point is there's been big falls. And yes, it's partly to do with the US Treasury yields going up, and therefore the price of these Eurobonds are going down. And we've seen much worse in Sri Lanka. So this isn't just an African issue, but it's certainly telling you that the market's getting more and more concerned about where we're at. I just want to finish with one last slide that is like the get out of free jail card in Monopoly. And that is, what I've been saying is that if you've got this young population, your savings are low, and your interest rates are high. And there's lots of data that backs that up. But we found an exception to that story. And the exception to that story is when a country runs a current account surplus. It's the mercantilist model of 17th century economics. It's the Asian model, if you like, of export growth, giving you a current account in surplus. That means you've got an excess of dollars swirling around in your economy that's come about from your exports. If you run a current account surplus, your real interest rates are pretty well zero. If you have a small banking system and a current account deficit, you're paying real interest rates of 3%. You don't build electricity systems when you're paying real interest rates of 3%. At least not very good ones, not very cheap ones. If you're an old country with a current account deficit like Britain, that's okay, because you're an old country, you've got massive savings anyway. But if you're a young country, it really is a problem. So the lesson here is that actually going down in the short run, and I mean short run in demographic terms, so we're talking like 3 to 5 years, in a short run, run that current account surplus, have a cheap currency. And it's not an easy choice. I was talking to a guy who was likely to get a senior economic role if the elections had gone a different way in the country a few years back. He was wanting his country to go for a much cheaper currency, but he said everyone will end up having to buy badly made goods in my country because they won't be able to afford imports anymore, and that'll be unpopular. But we're just going to have to do it because eventually those goods will get bought. The companies will have a little bit of revenues and start to make slightly better goods that don't fall apart, and the gradual improvement story happens. That's the way out. Anyway, right, so big picture. Big picture, we've had a whole lot of low-income countries have a very good 10, 15 years, partly because there was debt forgiveness 15 years ago, partly because global interest rates are low, partly because commodities have been fairly high for most of the last 15 years. And it's been pretty good. And they've managed to, the low-income countries have got through some of the crises as well. But it's not going to last the 2020s. I think we are going to see more debt defaults. And that's okay. When you look back at Reinhardt and Rogoff's book from 10, 15 years ago, 8 Centuries of Folly, talking about governments borrowing, they say it's 8 centuries of folly, but then they point out that all rich countries have defaulted at some point, and they still got rich. Latin America defaulted terribly in the 1980s, but has still made some progress since then. And I think we're going to see the same situation for those countries in trouble in the next few years. So it's the very last thing I'll leave you with, because I don't know what area of business you're in personally, but when there is a shortage of capital in a country, and all young countries have got a shortage of capital, all young people have got a shortage of capital mostly, the value attached to capital is then very, very high. The returns you can make with the cash that you invest somewhere can be extraordinarily high. And that's why we see investors getting involved in Nigerian banks or Pakistan's consumer companies, Egyptian kind of tech companies, because there is still a shortage of capital, and it makes the money you put in so valuable and the returns you can get so very, very high. So I'm going to stop there. Thank you very, very much. This was a short 30-minute burst of what should be getting published in the next month or 2 or 3 as the time-traveling economist, because I keep on talking about history. So hopefully this is like a short advert for that. Thank you very much for your attention. I think we're going to do some Q&A now.
Charlie, that was fascinating. Thank you so much for your views, your research about the longer-term possibilities for Africa and Pakistan. And I've learned so much, so thank you. But I do want to ask you a couple of follow-up questions. So talking about this new debt crisis globally that you mentioned, how do you think Africa and Pakistan are going to be affected? What can we learn from these past debt crises in emerging markets? Because, of course, we have seen them before.
We have, and so where it gets really bad was the 1980s. And actually, I talked to some of the older officials in Sub-Sahara who can remember the 1980s debt crash. And what was terrible about that for Africa was that they couldn't sustainably grow. That the education wasn't high enough then for the countries to do well without the commodity surge or the debt-fueled growth of the 70s. So when you went into a debt crisis, that it lasted decades, not just a few years. Latin America was different. Latin America, back in the 70s, had roughly similar education numbers to parts of Africa now. And when they went into the debt crisis in the 80s, it was painful for a few years. But actually, even by the late 80s, a country like Brazil was looking much better. By the early 90s, Mexico was seen as the flavor of the month. I mean, it overdid it, and we had the peso crisis in 94, and a little bit. It didn't stop the country's development. So what I guess I'm expecting is that countries will some, like Zambia, which is in the process of restructuring its debt now, but has very good education, actually has good electricity, Zambia does. That will be one of the success stories through the course of the 2020s, the surprise success stories. That the debt crisis that I suspect is coming for some countries won't be as bad as it was for those same countries 30 or 40 years ago.
Okay, Charlie, if I were to pin you down, how many years do you think it would take for these countries to recover from these upcoming debt crises? What would you say?
Well, look, we're literally in debate about it for a country like Zambia now, and it's an integral part of the debt renegotiation package. The IMF is saying growth is going to be something like 2 to 3% in Zambia for the next 5 years. Now, if they're right, that tells you that they can't pay back much of the debt they're defaulting on. Private sector saying this is nonsense. Zambia's look where the copper price is. This is one of the most successful copper producers anyway. I would then point to the good education numbers. They do have a problem. Fertility is too high. That's certainly an issue, but I think there's a good case for them to be growing at 4 or 5% over the next 4 or 5 years. So they've had 2 bad years instead of 20, which is what so many suffered after the 1980s.
So you're telling me history is different?
History's different when you put the countries when you see where they are on the timeline. So it's putting Sub-Sahara, say, or Pakistan onto that 1970s, 80s timeline, say, for Latin America or Asia, and that's the choice they have. Go down the Asian route and really take off, or the slower, less successful route of Latin America, which I think is connected to a slower improvement in education and a slower decline in fertility rates. Asia forward its benefits. Sorry.
Now, what about infrastructure investing in Africa and Pakistan? Where are the best opportunities? If people listening to this are thinking, I buy into your view, where is a good place for them to put money? You talked a lot about electricity, but also healthcare, education. Could you just talk us through where you think some of the best opportunities are?
Yes, I mean, but also to talk about what I think are somewhat problematic. So it's what we've seen. So let's take Pakistan 5-10 years ago, and China's in the middle of its One Belt, One Road initiative, lending out billions and billions, and something like $40 billion gets thrown at Pakistan. Now, interestingly, Pakistan actually does have enough power. It has not got good enough education to be an industrial powerhouse. So really, where would even 1 billion of that 40 billion have been best spent, or maybe 2 billion? Education. Just getting universal adult literacy I think would be more transformational for Pakistan's future. Bangladesh, they were once the same country if you go back 50 years. Bangladesh is booming away. 6, 7, 8% growth. Why? Because they got education right first. So personally, I would say that is the area that needs focus in Pakistan. But they had electricity, or some of it. The Chinese did finance some more, but there's also quite a lot going then into road and rail. That's reasonably straightforward for Pakistan because they had electricity, not as much as they'd like, but enough. When I look at some of the borrowing done in Nigeria at the moment, they're focusing on railways quite a lot. And I can see the attraction of that because it can get built within a presidential term. You borrow the money, Chinese come in, build the railway, fitted with Chinese engines, Chinese trucks, Chinese drivers sometimes, and it's up and running within 4 years. It's great. The difficulty is it doesn't produce goods to export. It doesn't give you the export revenues you need to service that debt. So I get quite concerned when the easy wins of a big infrastructure projects like transport is prioritized over what actually is necessary is electricity to get goods made in a factory and a port to export them. China didn't grow from the inland area first and then the coastal. The coastal boomed first. Why? Because the transport costs were minimal. And only after 20 years of that boom did the Chinese start building railways in a big way and trying to push the industrialization story into the hinterlands, the inland areas. So I think education has to be significant. Electricity, absolutely essential. Ports, and the stuff like roads, electricity, roads and other infrastructure has to come later. And just as a last point, one thing which struck me when I was writing the book was how many countries have made sure that they've focused on supplying power to industry first before people. It was done in quite a ruthless way. From France, the States, to Korea in the 1960s or 70s, it was always business first. It doesn't matter if the population has got no electricity at night. That's not important. You have to produce the export revenue raising industry first. And then you've got the money to supply power to the rest of the country.
That was a really interesting point, Charlie, about developing the coastal regions first, about China choosing to develop the coastal regions first. But of course, where does that leave a lot of landlocked countries in Africa?
Well, there is if I was that map I showed you earlier about the African map, quite interestingly, there's not that many people, thankfully. The very high proportion of the population is around the coast, particularly in North Africa, but even in a lot of the population density around Africa is all on the coast. Yeah, for the countries that are actually inland, properly landlocked, no choice, Congo, Zambia, Uganda, yeah, that's tough. That's tough. And then what I'd hope is, I don't know if you recall the special drawing rights allocation, which the IMF expanded in 2021. So in August 2021, $650 billion gets magicked up on the magic money tree by the IMF, of which 40 billion goes to, just over 30 billion goes to Africa out of 650. And like 100 billion goes to America, which doesn't need the magic money. They have their own magic money tree called the Fed. So there's this talk being that we're going to reallocate some of these special drawing rights, this magic money from America and Europe to Africa, low-income countries in Asia, potentially into this long-term infrastructure. And that's exactly the sort of, they're planning to do it in an ESG way. So there's a whole shift to green energy, but it's also could be used to help finance some of the infrastructure where countries have got no choice. And Congo's got no choice except for a little bit of infrastructure to the rest of the world.
Moving on, what about fintech in Africa and the possibility of greater financial access for the population? Clearly, that's very important. I mean, I'm thinking, is it like telephony when mobile phones sort of allowed many countries to sort of jump over the whole copper wire stage? Is it the same with financial services? Is that the same sort of idea?
That's the ideal. And there's certainly, you can see how it could happen. You've got tens of thousands, no, I can't remember how many thousands now, many thousands of graduates coming out of, say, Kenya's universities, right? Young kids who know vastly more than me about anything to do with tech, and they are setting up their silicon kind of savannah stories, and the idea that they could sell an app on the App Store to 100 million Americans because it works, and you can just transport it for free and sell it for free virtually, and actually then raise money. It's wonderful. That scope for an export boom on the back of services like that, it could be, hugely transformational. No one needs to spend quite as much money on railways or even electricity, because how much electricity do you need to power a phone versus a factory? There is a hope from that the cost of investment is going to be lower, the ability to jump will be higher. I am waiting to see data on this rather than, I remember looking at India versus China about 10 years ago. Everyone said India produces the services and China produces the goods. China actually produced more service exports than India did at the time, but it also produced 10 times as many goods. So far, we haven't really seen countries beyond, say, tourism destinations use services in that way. But I'm not saying it can't be done. I very much hope it can be done, and it would enable us to see much faster growth without the same heavy debt requirements, if you like, of this debt that normally has always up to now been needed for infrastructure, for roads and ports, electricity and so on. So hopefully that's a way out. But I'm not betting on it, certainly not in the next 5 years.
So you mentioned the magic money tree for infrastructure, and the fact that this money will attempt to sort of leapfrog the old technologies to use new, greener technologies. And of course, sustainable investing, a theme of our Alpha Summit series. So how do we in developed countries help frontier countries transition to a lower carbon future?
So I've been talking to investors now since at least the mid-2010s about solar power parks across sub-Sahara, actually. And I haven't seen any yet happen. But in the process of us talking, the price of that has been collapsing. When we looked at electricity and discovered that, in the West, you pay 10 cents per kilowatt hour if you're a business or a household, roughly, to get your electricity. But you pay more than that in Africa. But the costs of producing solar has gone down to sub 10 already. I think we're heading towards 5, and some people are suggesting we might be at 1 to 2 cents per kilowatt hour, the cost of production from solar, which then enables you, again, this positive sign that maybe technology is going to help support this cheaper and cheaper getting out of the problem of the shortage of electricity. So I think technology might already be providing this. And I think there is a shift already into saying, okay, if we're thinking 10, 20, 30 years ahead, we should be planning now, and we don't have to start from scratch. We are not inheriting huge coal plants in most countries across the continent that will continue to churn out pollution for the next 20, 30 years. I was supposed to be talking to the president of Guinea-Bissau the other day. They haven't got any power at all. They've got a boat that sits in the port from a Turkish company called Carpool, and they supply the electricity to the city, and that's it. So when it comes to producing power, it's not hard to start from there is none, or certainly too little, to trying to do it in the absolutely right way. The best possible way, which is why I'm convinced this is going to be the greenest industrial revolution we've ever seen.
Well, Charlie, that was a fantastic discussion. Thank you so much for your time. Charlie Robertson, Global Chief Economist at Renaissance Capital. Thank you so much. Absolutely brilliant. Now, we're going to take a short 20-minute break. During this time, we encourage you to connect with our sponsors in their virtual exhibit rooms to learn more about these firms, their offerings, and their industry research. Thank you again, and see you in 20 minutes.